Amit Shah, Managing Partner, IIFL Wealth, joins us right now in our studios to talk about that. Amit, really good having you. Thanks so much for taking the time out.
Thanks for having me.
Now, I'm giving you a hypothesis that there is a decisive majority or a mandate with one partner, which is a clear government for the NDA. How do you think the markets react in the near term, which is the next 1 week? I know it's a difficult call, but yeah, and over the course of the next 6 to 12 months.
See, I believe next 1 week obviously would be euphoric, either ways, whether we get a decisive mandate or we don't get a decisive mandate, in that 5 or 10% up or down is something which is written on the wall. I think what is critical for us, assuming if we have a decisive mandate, which means that, the popular leader comes in and forms a government with a clear majority, I think in that scenario that throws a big positive for foreign investors. If you look at, this year as we started off, despite the NDA numbers expectation moving from 170 to 250 as we speak, the FI flows have not been commensurate with it. So 2 years before this year, if you look at it calendar years, FIs have pumped in close to around $45-50 billion into India. So average of, let's say, around $20 billion a year. So we are 6 months almost there. So by that logic, 10 billion should have come in. And this for 50 billion came in without the decisive mandate, at least, in consideration. So by that logic, we are anyways 4-5 billion away. From a global perspective also, if you look at it, other competing economies where the flow can go in, a lot of these economies have its own internal issues, whether it's China, whether it's Russia, or, to an extent Brazil. So from that perspective, if I'm a global manager or an allocator, if I'm allocating money and if I see a decisive mandate, in India, obviously from underweight going to normal is bound to happen. Plus, on the domestic side, we have not seen any investments done by any resident Indian investors. So last 3 years has been all negative flow. So I think that itself is waiting for a stable government to come in play. So if both these factors start working together, you're going to see that kind of humongous flow to come in the next 2 to 3 years time. So to answer your question in a short way, 1 week, depending upon whether we have a stable government or not, plus minus 5 to 7%. But next 2 to 3 years, I am personally quite bullish on Indian equities.
Okay, Amit, now you look at equity assets of about $4 billion, $3 billion in advisory, and $1 billion is what you manage directly. So essentially, you're talking and you are kind of directing a lot of the foreign money into the Indian market. What are clients feeling at this point? Do you get a sense that in the last 3 to 4 months in your client conversations that people are willing to allocate more money? Are you getting bigger mandates from funds?
So as I mentioned, most of the global investors have been underweight on India. So from underweight in the last 3 months, a lot of them have made it India as neutral. So that itself has, seen some reasonable amount of allocation to come in. Even our funds have seen some decent amount of flow in the last few months. But I think the core money, the old money, which is real long-term money, that has still not come into India for obvious reasons. Because if you look at 2011-12, we are seeing currency rout happening. Then
so what is in the profile of funds putting in money over the last 3 months, and how is that likely to change? Are we going to see more sovereign wealth funds, pension funds allocating capital post the election results? Where will the source of money be?
So if you look at last 2-3 years, I think predominant money which has come into India would be classified into either sovereign funds or ETFs, which is either a core retail money or a core wholesale money. Whereas most of the money managers we interact with globally have not been able to raise any significant or substantial amount. So all India dedicated funds, if you look at it, which have been launched in the last 3-4 years, they are struggling to raise assets, which clearly means that the core family offices, the old wealth which has been there, which comes in form of pension allocations and stuff, has not happened to that level it should have happened. And as I said, that's for obvious reason, because India was underweight in most of their portfolios. Now, assuming if we have a stable government and if we see the clear mandate based on what people are expecting, and if it's a progressive mandate, I think that money has to come into India, and it's just a matter of time. We speak with a lot of institutional investors who have given us a feedback that if they see the day they see the stable government and a clear mandate, the kind of money they are committing, each of them are in the range of $500 million to $1 billion plus into India. Wow. So from that perspective, that's what I'm saying, 2 to 4 years, extremely bullish on India.
So let's assume there's a gush of money waiting to come into India. where does it come in? Because there are a lot of stocks which are trading at significant premium, and the stocks which are not trading at premium are essentially still in distress. Does money find its way into cheaper valuations, which would essentially be in infra, maybe even some capital goods space or construction companies, or does it still favor the outperformers, the likes of IT or pharma, which are export oriented, or some of the maybe the consumption names, which are essentially defensive in nature?
It's an interesting point you have made, and I think the rally which we have seen is kind of a myth, because if you look at the last 9 to 10 years of average of valuations, India has been trading at around 14.2 times 1 year forward. Today, after the rally, whatever we have seen in the last 6 months, we are still at 14.1. Now, this 14.1 has not been, valuation is not derived from a secular rally which we have seen. There is kind of a lot of distortion. So, if you look at it, my view is, if we see a stable mandate, the first flow of money which will go in would be cyclicals and not the defensives. Because prior to 3 months before, let's say last 2 years or last 2 calendar years, significant portion of money which has come in are all in defensives. And, for obvious reasons, because there was no clarity on the government side, reforms, etc., etc. From a valuation perspective, if you look at it, my view is most of the defensives are fairly valued towards the rich valuation, whereas cyclical, especially the financials, if you look at it, they are nowhere closer to the January 2008 numbers. So if one has to look at January 2008 as a base, which was the peak of that market, and assuming today is the peak of the current market, right, 7 years down the line or 6 years down the line, valuations of banks, financials, infra, they are nowhere close to what we used to see in those days.
So let's talk about these pockets. Banks, and I believe you will agree with me that private banks aren't exactly cheap. Sure enough, some of them may be, but a lot of them are trading at highs. That leaves the PSU banks. Are you saying that there will be clear money running into PSU banks? And if so, would it be restricted to the top tier ones, or would it find waves across the spectrum?
See, let's talk about two pots of money, right? One is offshore money coming into India, which will come in larger quantum, and one is onshore money, which is typical retail HNI money, which would get invested in. Now, if you look at the psyche, for a foreign investor, the first and foremost important thing for him is liquidity.
Sure.
Irrespective of valuation, first parameter is liquidity, that if I invest into this stock, will I be able to exit or not? So by that logic, obviously the first round of allocation will come into more liquid stocks compared to more illiquid stocks, which are typically a mid and small cap.
So the likes of SBI, etc., you think will find favor?
Correct. And then obviously private banks. Now private banks have its own challenges, as you would be hearing in media. HDFC has an issue. HDFC bank limits are more or less there, right. So the allocation into MSA has gone down, etc., etc. But given a choice, obviously companies which are liquid is where the money would flow in. Now, what I believe is, if we see a stable government, and assuming a decisive mandate, in that scenario, the first and the foremost thing the government would do or should do is essentially try and improve your banking system, right? Because that's a core to your any kind of growth. Because any dollar coming in converts into $10 going out because of the money supply effect. And I don't think so. It's a difficult thing to do. It's a long-run process, but if you have a will, one can do it. And the classic example is if you look at the power distribution companies in the state of Gujarat, assuming that if you're talking about decisive mandate, the way a non-profitable structure has become so profitable. So the good part about India is we have policy framework in place. We just need implementation, in the right spirit. And if government is determined, I think the core asset drivers, which is a bank infrastructure, if they have that due attention and the balance sheets are held to be cleaned up, I think the growth numbers there can be quite significant.
I know, but if we were to just drill it down to specific names, sectors and subsectors in the entire infrastructure basket, or like Neeraj pointed out, PSU banks, private banks, NBFCs, where is the maximum amount of interest building? Where do you think you're getting client calls to say, if we get a decisive mandate, we want to enter into these names or these sectors?
See, honestly, on the international side, if you ask me, the first question was still 2 months back that India was underweight, so there was no question of putting money into India, right? So now when an individual decides, or in fund manager, because fund manager works in a very different psyche than an individual investor as we see on the street in India. So when he decides that he wants to invest or allocate money into India, the typical allocation would go from a top-down perspective. So one would try and look at a broader index allocation, indices, liquidity, etc., etc. So valuation obviously being one part of it. So the interest which we are getting clearly is on broader segment on the cyclical side. So So, if you ask me, I can't comment directly on stocks because of my compliance issues.
Sectors, essentially.
Yeah, so from a sector perspective, all the sectors which are linked to asset creation in a broader ways, which means banking, core infrastructure, whether you are building infrastructure, you are managing infrastructure, or you are creating infrastructure. Anything which drives your, asset creation, so NBFCs, financials, private sector, public sector banks, etc., etc. That is where we are clearly seeing interest. My view is with a decisive mandate, probably FMCG, defensives, all these sectors which have been doing phenomenally well in the last 2 to 3 years and are very close to their peak valuation that we are seeing in 2008. There we may not see that much of interest or flow of funds going in, because if we believe that structural things would change, then valuation wise the other segment looks pretty rich. So given a choice based on tomorrow's decision, my view is if we don't get decisive mandate, defensives look good because everything would correct, which means defensive is also correct, right? So that would be a good point to accumulate it. If we get a decisive mandate, then I think one should not bother looking at them. It makes sense to build a 2 to 3 year quality portfolio of quality names.
What about policy sensitive names? What about state-owned companies? Energy or banks?
Policy sensitive names, I believe would not react immediately tomorrow. One would need to see what kind of ministry has been allocated to whom, So if you see, a favorable ex-minister coming in for an Y portfolio, then based on his past track record, any industry or company directly or indirectly linked with that particular segment would do well, or vice versa. So I think individual stock wise, split, one should look at only post the ministries are announced. And I have a very different view. My view is when you believe that overall things are going to do well, it's going to be a difference of 2-3% here or there. So when you're talking about making a 15% plus consistent return in the next 3 to 5 years time, 2% is not going to change anyone's life. So, because those answers one would only get once we see the ministry announcement, and I don't think so that's going to happen overnight. It's going to take at least 2 to 3 weeks time.
It's an interesting point, and we would want to talk to you about this. Amit, I request you to stay on for just a bit more. We'll just probe a few other points with you. It's 2:55, so that time of the show wherein we should get trading ideas from Ashwini and Mitesh. It's a difficult call, Janpan. I agree, but Ashwini, would you have a trading idea?
So it's not a difficult call. You can easily assume that whatever happens, IT will probably correct some more. So maybe, TCS you can go short on with a stop around 2200 and look for targets of 2140.
Interesting. Mitesh, what about you? Your top trading idea?
A cash idea, Motilal Oswal Financial Services, I think trading at about 124.90, making a fresh 52-week high. It's given a good breakout. Buy that with a stop at 119, look for targets of 135.
Not bad. You get the whole Motilal Oswal team tomorrow on ET Now as well to speak about their reactions on the election results, and the stock is also doing well. Nevertheless, take a quick break on that note. A couple of trading ideas, just watch out for those. We're still in conversation with Amit Shah. Ashwini and Mitesh, of course, stay on. We'll also get in Sandeep Wagle and what dealing rooms are recommending on this all crucial day, just the day before the election verdict comes out tomorrow. Stay tuned to ET Now.
Welcome back. You're still watching Closing Trades right here on ET Now. Let's just go across to Sandeep Wagle, who joins in with the strategies for the last half an hour. Sandeep, your position on the index, whether you have a position at all right now, or have you squared off your position, or are you going to be looking at the option side to kind of play the range? And secondly, your stock specific strategies.
Good afternoon, Tanvir. We don't have any position on the Nifty. We have a view that it will be in that 100-point band, and tomorrow I think we will see a 500-point move. That is what I feel, 7,200 to 6,700, 750. That is the range I feel for the Nifty, and we probably can see some correction tomorrow. Individually, I have a buy in a Tata Steel, stop loss of 445, target of 515, and a sell in United Spirits, stop loss of 2635, target of 2460.
Okay, Sandeep, many thanks for those trading ideas as well. The index is flat. The CNX mid cap and the CNX small cap indices have cracked incidentally. So 1.25% down for that, both these indices. So I think intraday you will see there has been a bit of a sharp gash for the CNX mid cap and the CNX small cap space, maybe some profit booking there. No great losers really, 3-4% odd for a Biocon, Motherson Sumi, a Thermax, etc. So no great losers there, but yeah, the indices by themselves have come off quite rapidly. Some nervousness ahead of the verdict tomorrow. But the index, of course, Sensex is back in the green, the Nifty is still just about flat. The broader markets are slightly nervous. Amit, I know you can't talk stocks, but let's try and drill down to something which will be easy for the viewer to grasp as well, in terms of him making his decision. You said that let's leave defenses out for the moment. We've spoken about banking. What about oil and gas? And I'm specifically talking about people saying that there is probably a gas price hike in the offing. The currency may strengthen, which may help companies like ONGC, so on and so forth. I'm not asking you to name a specific name within Reliance, ONGC, etc. But the non-oil marketing side of the space, are you bullish on that pocket at large?
See, I would take this question in a very different way. If you look at currency, we clearly believe that because typically these companies have a direct correlation, with the currency, because that gets impacted on the subsidy side. Our view is that currency would be stable to appreciating in the near future. When I say near future, is in the next 12 to 24 months time. And all of my comments are subject to be getting a decisive, government. So if once we have that in place and we have a strong government who can take that call, on the subsidy and bite the bullet, I think all these companies would have a positive bias from an investor perspective, because a lot of, I would say, hidden cost or unknown cost, to be very precise, which gets loaded onto them because of the FX fluctuation where they don't have any part to play, would all get knocked off from the balance sheet, and then what you would see is a clean balance sheet. If you look at this segment per se in the last 4 years, has been a gross underperformer, from top to bottom, all the stocks. So, as I said, again, it depends upon how the ministry gets formed and what's the kind of mandate, of the minister, how to drive it. But assuming everything falls in place, one would say that, that segment looks interesting.
What are you pricing in for currency? You said you expect more appreciation. Are you looking at specific levels?
No, I don't. Yeah. So what I believe is it won't depreciate too much, but my view is RBI would not allow it to have a free appreciation also, because if one has to do a broad math, if so much of flow one would expect in the next 2 to 3 years, then one would have a positive bias towards currency. But in history, if you look at it, whenever India has seen a bull run, like classic example 2004 to 7, that's the time RBI took as a golden opportunity to build up forex reserves. Post that till October of last year, our forex reserves was static. We never moved beyond that magical number of 240, 50 plus. Post October, we have seen some build up there. My view is India should have a forex reserve at least $450 billion, and the RBI governor would have a golden opportunity to build that up in the next 3-4 years if we have a decisive government and the foreign flow starts coming in. That will also help checking in the currency, because I don't think so any central bank would want to have a volatile currency either ways, whether appreciating or depreciating.
So give us a range. I mean, you think 58 would hold?
My view is I would bet on a number of between 58 and 60.
Okay. I'll come back to pockets within the markets. Power. Is there a space that you think where the fortunes can revive? Variety of reasons. You spoke about infrastructure. I believe power would fall right in that basket. And name a stock and it's probably at its ebb right now. What's your call there?
See, power as a segment, if you look at it, has been struggling because of policy issues. So if you talk to any promoter running the company, says everything is fine except the policy. And that's the reason for the massacre of the balance sheet. As I said, without power, any infrastructure growth cannot be done. So whether you are looking at alternative power space or normal traditional power space, once we have clear mandate and a focus on that, and we have a support from the banking system, to in restructuring of loans, obviously that segment is something which can get revived and can live up to its true potential. and that brings to a point that there has to be a clear mandate to revive the banking balance sheets, mostly PSU, because most of the exposure to this segment is from PSU. Also, my view is if you have a clarity on policies, then you may see a lot of FDI coming into these kind of long-term core infrastructure space, which is core foreign money, long-term foreign money, and internationally, if you look at it, most of the countries get tons of money into this segment through FDI route, which we have been missing because of lack of policy measures.
So you're bullish on power if things go well?
I'm bullish on everything if things go well,
That's true. No, you're really saying story from defenses.
Because interestingly, India has actually gone nowhere. So as I said, last 9 years, and I come to the same number, which is basic common sense number. Last 9 years, India has been trading at 14.2 times average. Except last 6 months where there has been some hope which has been built up of stability. Rest all, period has been absolutely, marked by corruption, indecisiveness, etc., etc. So from that perspective, obviously, one would expect things to move up.
Okay, before we let you go, and I think Neeraj may have one more question to add, but I just wanted some numbers from you. While we were tracking that number, Neeraj and I have this discussion pretty often, that, we're tracking that benchmark number of 6% average allocations, benchmark to the MSCI, which is what foreign funds have in their portfolios as part of their exposure to India. You're saying that some of them are undermarked, right? Give us an average range that foreign funds hold, and where can that number go to in, let's say, the next 6 months post the election announcement tomorrow?
See, my view is the segment which we are talking about to benchmark themselves with MSCI would be probably around 50-60% of the global money. The balance 40-50% of global money is opportunistic money. When I say opportunistic money is that they are all tactical plays. So that money flow, has nothing to do with whether MSCI India has 6%, 8% or 4% allocation. The guys who benchmark themselves with MSCI, a lot of them, were underweight till now. So now my view is by this time, a lot of these guys would have, benchmark themselves right there, and that's what we have seen last year and whatever flow we have seen this year coming in. My personal view is the kind of investors we are meeting with, more of them are these tactical varieties where, they would want to take an India bet, which has nothing to do with their linking with MSCI or what percentage. And their portfolio allocation would obviously depend upon their risk profile. But once we have a clear mandate, you may see this new money which, which I expect to come in, which would be a combination of family office, retail and, other forms of money, which is core, stable, long-term money into India.
We hope that does happen, Amit. And thanks so much, though, for taking the time out, dropping by in our studios and giving us your views. We look forward to having you more often, really, on the show. Thanks so much for joining us.
Thank you so much.
That's an important voice. Amit Shah of IIFL speaking about his views on the markets. By the way, we were talking oil and gas with him, and litigations against Reliance pile up. Sources tell Shriram that the state-owned oil